Okay, we are live. Right, let's begin. So let's start with what is the key topic that I'm going to cover today? All right, what is that sort of one point that I'm going to really sort of outline in this live market analysis session? So the question that I have here is, have markets bottomed, and what is next for cryptos? Right. So we're going to talk about, are we sort of in capitulation as markets now mostly have driven, we've seen 7 consecutive weeks of downside movement. Is that all we're going to see? Are we going to now bottom out and then we're going to start to see a bit more of a bull run taking place? That would be sort of the key point that I want to sort of really outline from this trading session. From this market analysis session. In addition to that, we'll have a look into cryptos. Cryptos is sort of an area that I would like to also touch on, especially what's happened in the last few weeks. And maybe some of the crypto side of things may help us indicate whether we have bottomed. Okay. So let me just go on to something else for here. Right. So let's start with having a sort of quick discussion of what's taken place so far. Right. Last week was another brutal, wild week, right? A very volatile market session. And we've just seen a sell-off continue, and we've seen now 7 consecutive red weeks. Now the question is that all for now? Is that it now? Or are we going to see a continuation to the downside, right? This brutal, relentless, and historic selling pressure that we've seen over the past 7 weeks has led to a lot of fear in the market, but we've not seen panic set in yet. Okay, so we've seen fear in the markets, but no panic at this moment. But what has taken place, right? So we've seen tech and growth names are, of course, getting the most hit, right? Getting hit the hardest out of all sort of equity stock market, right? Out of all the sort of stocks within the equity markets, should we say? It started off, though, with a lot of the tech and growth stocks being hit first, right? So we know that we've seen this, that money's coming out, the money flows is coming out of these growth and mostly going into value names. But now even within its value area, we're also seeing them being hit quite hard now as well. So we're seeing where we move out of growth, go into value, but now we're moving out of value and we're staying away from discretionary, and we're probably going into more staples, right? So discretionary, consumer discretionary, and consumer staples, right? It's leading us to go into more defensive stocks. That's what we're seeing at the current moment, is a view that I need to go into something that's safe, right? If you're in the chat, if you're in this live session, let me know what stocks are safe. What do you class as a defensive stock? Right. I'll give you one. Coca-Cola is seen as a defensive consumer staple. Yeah. So, So in a nutshell, we're seeing a move from growth stocks to value, then from value to discretionary, from discretionary to staples now, as we move to a defensive play. Right. Investors are becoming more selective in where they want to deploy their capital, where they want to invest in the market. Right. So last week's sell-off can be brought down to sort of a key area, a key theme that had taken place, which is earnings, right? And not just earnings, but a miss of earnings. More importantly, the content of these earnings came down to two stocks in particular. We had 2 retailers, Walmart and Target. Yeah, the key points, especially coming out of Target and the earnings call, that jolted the market, and we saw this sell-off continue, right, was a massive cutback on discretionary spending by consumers. Yeah. Also, the rising cost across almost all product categories, and the impact of that on the margin, because in current inflation theme that we're in, right? And this earning call that resulted in sort of these key outcomes, these sort of key themes being touched on, it just proved that there is an inability of the retailers to pass down the cost to the consumers yet, and their margins are getting tighter, and that's going to lead to potential more profit warnings, less profits being made in upcoming quarters. So this dramatic cost increase, and will start preparing to be moved forward, as we're going to see now higher prices continue. Is inflation going to actually come down, or we're going to see inflation continue or stay at these elevated levels that we've seen that are at these 30, 40-year highs, right? But anyway, whatever the scenario might be, this is pretty much a devastating news from the earnings report from Walmart and Target especially, right? We're now seeing that these talks are becoming prevalent in market conditions, okay? And that's why it's important for you as an investor, trader, to keep an eye out on upcoming earning reports and really listen in to sort of the key themes that they outline that they are potentially struggling with at this current moment. Yeah. Okay, so let's have a look at some of the equity markets. So we'll just switch over to some of the markets here. We'll come over to sort of, we'll put a focus on the equity markets before we move on to some of the commodities, FX, and then of course, cryptos. Right. So we now know that, okay, a lot of the reaction from last week was down to these two earning reports, more specifically one, right? But what's taken place thereafter, right? So this sell-off that we've seen, which has been expedited by these earning misses, and more importantly, the content of the earning calls of those two key sort of retailers, Walmart and Target, led to markets to sell off, right? The key areas that we want to sort of highlight is we want to put a focus on US tech, right? US stocks and US tech as well, right? One of the key elements that I would suggest from last week is if we look at the S&P 500 and we switch it down to a little bit lower time frame, we'll move down to a lower time frame. What's the fact that if we go from all-time highs, which are sort of in this region here, down to this point here, right? So what we saw was we had previously tested on the 12th of May, right? So 12th of May, towards the end of the session, we saw the S&P 500, which is the benchmark for global equities, come and test the 20% sell-off, Didn't quite cross through the 20% sell-off. We saw that was the opportunity for most traders to buy at those lows, right? But we had a rebound. Through till the 18th of May. So we had a rebound through to 18th of May. From that point onwards, we saw the sell-off continue, and that sell-off sort of, tested a resistance around the 4,080 figure, 4,000 sort of, almost 100 figure potentially, and thereafter we sold off, and we did on Friday enter in bear territory. Okay, so we did go into bear territory in the markets, right? Now, it didn't close at that level. In fact, it closed unchanged, right? So the markets quickly sort of snapped back once we crossed through the 20% mark there, right? So through the 20% sell-off, bear territory, bear market territory, snap back, pulled back up, back to sort of test almost the 4,000 figure potentially, more likely the 3,956 figure. So 3,950, right, figure was tested there. But that just shows how the markets, every time we test this 20% sell-off level, which is seen as a bear market, right, thereafter, anything greater than 20% sell-off in the market is seen as a bear market, right? Now, we've pulled back twice now, right? So we've tested this multiple times now, and we've pulled back each and every time. Now, the question is, as I mentioned, is that the bottom, right? Is that going to be the bottom? So right now, if I just remove this, I no longer need that. Switch back over to sort of the daily time frame. So markets remain unchanged Friday session. As we look in sort of from the weekend and where we are at this current moment in the futures market is up. Okay, so we're up 0.67%, 0.65% when it's the S&P 500. Looking at the Nasdaq's also up around the same, 0.62%, 0.63%, but it's showing a little bit of rejection to the top side. Okay, we're seeing already a bit of rejection to the top side. Remember, this is futures market. This is not we've not actually opened the US market session yet. Looking at the Nasdaq, which of course, where we saw a lot of the tech names slide significantly in the first 4 weeks of the consecutive sell-off that we've seen the last 7 weeks, right? Looking at where we are from all-time highs, we're greater than sort of bear market for the S&P 500, but you can almost say that the bear market for the Nasdaq, as it's a more volatile asset, you could see that there may be a different percentage allocated for a bear market in the Nasdaq. That could be the 30% mark, right? So you've seen now potentially, two levels, two strong tests of the 30% sell-off. We've not closed below the 30% level yet, right? So you can see, so there's been no candle closes through the 30% sell-off yet, okay? But yeah, I mean, we've seen, if I now apply that again from where we are at the high, the lowest point we've been is a 31.44% sell-off. We're currently sort of testing a 29% sell-off at this moment. And the question is, are we going to rebound at this point of the hair as well? Okay, so yeah, so we've seen a 20% sell-off in the S&P 500. We've seen a 30% sell-off in the Nasdaq at this moment. Yep. So just refresh that. But so far, markets are buoyant, right? Markets are rebounded, paring some of those losses now that we've seen over the number of weeks, and starting the week on a positive note. European markets, European stocks rose on Friday's session, yeah, but then they logged in that negative close that we'd seen. So overall, for the week, I believe it was the FTSE was down 1.5%, close enough to 1.5%. Travel and leisure stocks climbed. They did quite well, but we've seen sort of other factors come into this as well. Now, if we look at the UK FTSE 100, so if I just come over to the FTSE 100, and I've mentioned this a number of times now, right? A number of times. So looking at sort of from where we are, if you take it from all-time highs from that point there, right? So we sort of tested as all-time highs around this region. Where we are at this current moment, we've only seen a 2.5% correction. So clearly, US markets are far more in negative territory than we're seeing in the FTSE 100. Okay, so we are seeing the FTSE 100. But do note the rise that we had seen if we look at the rise. Okay, so if I now move up to the daily time frame, and this is something to sort of consider. Oh, this is not showing me going back as far as I want to go. Let's just switch it over to a different UK 100. Let's look at maybe there. Okay. Stop being as far back either. We'll try, yeah, it gives me a bit more data there. Okay, so just looking at, I want to go far back as sort of the COVID. Okay, so we're looking at COVID. Okay, now looking at FTSE 100, where we are at this current moment, and if you compare it to pre-COVID, right, we've not made much headway. We have not made much headway. Okay, so we haven't seen that the UK equity markets make all-time highs and continue to make all-time highs post the pandemic, post-COVID 2020, right? So even though we're back at those all-time highs, right, and markets have not sold off as much, right, but we didn't see the same amount of gain as we saw in sort of US equities. Okay, so if I do the same thing in US equities, and we look at pre-COVID, that's the gain that we've seen. Okay, so if we take the lows, from that point through to the highs, that's a 121% gain, 121% gain. If you bought at the bottom, let's assume that you bought at the bottom, going from sort of where you are to where we are now, we're still sort of up around 81%. But if we take the percentage from the high pre-COVID, okay, so the high pre-COVID to the high reached at this point over here, it's a 41% rise, okay, from that point, 41% rise in the S&P 500. And that's why I believe that we're not seeing that much of a sell-off in that FTSE 100, because it was a lagging stock. It was a lagging asset class, right, in comparison to how other equity markets have really outperformed over that period of time. DAX as well. DAX sort of, testing this nice downtrend line I have in place. Okay, so we're seeing sort of, quite a few touches to this downtrend line. We've not breached through a prior resistance or back above the trend line over here. So yes, there is still a bearish tone overall, but the question is, are we going to see a short-term bullish bull run based on sort of the amount of selling pressure that we've seen? That may not be the case in the European equity markets. We may see that more occurring in US equity markets. But hey, let's see what takes place. Okay, now switching over, we've gone through US and European equity markets. Now, touching on commodities, and one of the commodities that I'm interested in, I'm looking to sort of, participate in, should we say, if I haven't already done so, is gold. Gold is certainly sort of showing some bullish incentive, especially sort of coming into the trading session this morning, right? So now there are two sort of key elements here, right? So I think gold is going to continue to advance as we see the equity sell-off and that move to more a safe asset class, as we're seeing now, that sector rotation occurring where we're seeing markets move into value, right? From they're going to value stocks now to defensive stocks, and potentially when you're in defensive stocks, you might want to increase your holdings of gold within your portfolio as well, right? And that's where we could see now gold perk up a little bit, as we've not seen much of an upside movement for some time now. Looking at the last one we reached sort of close enough to all-time highs was in March, 8th of March, right? So since then, we've been on a downward slide. We had a bit of a bullish move between sort of, early April, first sort of week or two of April, but thereafter the downtrend continued, right? Now we've seen equity slide, and that could be now positive sentiment for gold, especially that we're moving to more defensive, more of a defensive play, defensive stocks. Second thing I'll probably say is, we're seeing treasuries as well as the dollar retreating. Okay, so treasuries are being impacted, dollars being impacted. We've seen dollar on the slide as well. I'll bring the chart up later, and that's the direct correlation that we have with gold. Gold is, XAU USD, right? And from a technical perspective, okay, so I've got this trend line in play. We've got clean touches here, 1, 2, and we've had the third sort of breach on this level, but we didn't close below this level. So we tested this zone again, also this prior support level around just the 1787 handle. And since then, if we just maybe drop down to sort of the 4-hour time frame, you can see how quickly sort of, we broke through the resistance here. We broke through this resistance trend line over here. So with this downtrend line in place, we've got a potential inverse head and shoulders formation as well, potentially. We've had a breakthrough, went sideways, potential retest, and we've had a new high now. Okay, we're almost looking to sort of breach through this resistance level. We've closed through it. The question is, are we going to pull back and then make a new high? Yeah, there could be sort of a turnaround play taking place in gold. Okay, so we see some bullish incentive coming back into gold. Yeah. Let's also look at oil. Let's look at oil. If you have any questions, guys, put it in the chat. If you have any questions, please feel free to ask your questions. Right? Looking at WTI oil as well. Again, you've got to be more in line to keep in touch with the fundamentals involved with especially the oil market. Right. One, we have a potential EU embargo of oil, Russian oil, right? Now, we know that is being limited, right? There are disputes within the EU in regards to whether they should go ahead with that. So that's one area to be concerned about. The second is, of course, an increase in production by the UAE, right? So some of the OPEC members might want to increase production levels, but at the same time, we have, China in regards to their restrictions, their lockdowns that are occurring. Now, they've given us incentive to a reduction of their measures, right? In due course, there's a timeline that's been set there. But again, you've just got to be mindful of, COVID cases in China. And we do know that there's been a slight increase in COVID cases, especially over the weekend that we've seen here. Now, how much of that's going to impact their restrictions and the removal of the restrictions is another question as well, right? So yeah, just be mindful in regards to sort of, the key points there as well. Okay, now let's switch it over. I want to shift over to, let's go into sort of, a different view over here, potentially. Let's see if that may work there. All right. Okay, cool. So I'll do a full screen. Let's see what's going on there. Hang on. Okay. I'll just, right, okay. Cool. So let's come on to sort of the Forex markets. Before we go into Forex, the sort of the key area that I want to put a bit more focus on is if we just have a look at the VIX, maybe go up to sort of the daily time frame. Full screen here. Okay, the VIX is a volatility index. It's just giving us an indication to how much fear and how much panic there is in the markets, right? When you see sharp rises in the VIX, you know there's a lot of fear in the markets. Okay, so you can see I've got two types of volatility index. I've got one for the S&P 500, another for the Nasdaq, which is the orange line. And this was sort of COVID. Okay, so we saw COVID's impact, right? So you see that large thrust taking place in the volatility index, testing the sort of 80 figure previously. Right now, even though we're seeing consecutive sell-offs in the market, consecutive weeks of sell-offs in the market, but there's no follow-through with panic in the markets, though, right? So this is what I mean, right? Markets are moving to sector rotation or holding and hoarding onto cash more, right? Rather than saying that, okay, we're in a panic, we're all fearful, let's go into something that's safe, right? Which is gold. It seems like markets either going to defensive place and allocating the capital into more value and more safe sectors, or they are holding onto cash and looking to potentially buy the bottom, buy the dip, shall we say, right, as an opportunity. Now, yeah, with a VIX, we're not seeing a sharpish rise in the volatility index. We haven't even broken the prior highs yet, right? Being sort of in this sort of 36 handle, 37 handle there, right? And we're seeing a bit of a downturn, in fact, in the volatility index. Looking at sort of the four key currencies that I tend to sort of focus on, which is the euro, sterling, dollar, and the yen. We're seeing a lot of euro strength come through. Dollar weakness continues, all right? So we're seeing dollar weakness continue especially in the daily time frame. And a lot of euro strength coming in, especially this morning. There was reports by ECB's President Lagarde, suggesting that the APP sort of, net purchases will come to an end quite soon. She's given a very hawkish view. In regards to the euro. Just looking through here. Yeah, so mostly the key point that ECB's President Lagarde has mentioned from this morning is we are likely to be in a position to exit negative interest rates by the end of Q3. And that's led to a lot of bullish incentive in the euro. So coming back to the euro, if I now dial it down to maybe the 1 hour time frame, where you can see it quite clearly. Yeah, so we've seen a large push in the euro, especially this morning, breaching through some of these key levels of resistance. Okay, so we had a resistance at 106.35 handle, so we broke through. Just be mindful, we could see sort of a retest potentially before we see the next leg higher. But this is certainly a very hawkish pivot from the ECB. Sterling also pivoting to the upside as well. We're seeing a bull run occurring here. Testing, where are we testing? We came quite close to test the 126 handle. Do pay regard to these psychological numbers. They certainly have an impact in sort of, being turning points in the market. Okay, so quite close test to sort of the 126 handle, showing a bit of an indecision candle up there, so potentially a shooting star. But we'd have a small wick to the sort of the lower shadow that we see there. So are we going to see some continuation? Well, this largely comes down to sort of the dollar weakness that we're seeing. Okay, so this largely comes down to the dollar weakness that we're seeing in the markets. So just be mindful of that, the correlation with the dollar weakness. Also be mindful of the Bank of England. I do know that today we have a couple of speeches from Bank of England. So we are expecting a speech from Andrew Bailey, the governor of the Bank of England. Now, he came out. He did come out in the last week and the week before in a very, very dovish mood. He come out in very strong statements, even referring to the word apocalyptic. Okay, apocalyptic, concerning with the cost of living, rising inflation that's sort of close enough to 40-year highs, and sort of all the key sort of themes that we're seeing at play from a macroeconomic standpoint. So, yeah. the key question here is: Are they gonna raise rates at the next meeting, right? So we'll hear more from him today, this afternoon. I believe he's set to speak around 3 p.m. UK time. Yeah, coming over to looking at the yen, right? So if we're looking at sort of dollar yen and sterling yen, I'm just zooming out, looking at the big picture view. We had this sharp rally that we had seen in the dollar yen, a lot of dollar strength coming through, a lot of yen weakness, because now what we're seeing we're seeing majority of central bankers moving to more of a hawkish and more of a raising rates, reducing their QT, reducing QE, allowing for QT, so quantitative tightening, as well as raising interest rates and giving very hawkish views in the markets, stating their forward guidance of rate hikes on an ongoing basis. Whereas the Bank of Japan have taken a more accommodative stance, and that's why we're seeing a differential between the yen and all other sort of major G7 pairs, right? So just be mindful of what's taking place from a central bank standpoint there as well. Yeah, dollar index. Let's have a look at the dollar index now. Where do we forecast the dollar index, right? So yeah, I mean, if I come up to sort of slightly higher time frame, you can see we've got quite clearly sort of a key level of resistance, another sort of high and resistance level around the 104 handle, a downtrend line in play. So we've had the breach through this, right, and the retest, and tested a new high, testing almost the 105 handle. Okay, so we got up to the 105 handle. From that point, we've seen markets slide, but I don't see that there's going to be so much so of a downside move in the dollar, especially given that we know that Jerome Powell and co, so the Federal Reserve, are likely to raise rates. The upcoming 2 meetings is forecasted for a 50 basis point rise in the upcoming 2 meetings. Thereafter, a pivot to 25 basis point rise towards the end of the year. But the question is, where is that floor for the markets? Now, a lot of it has been priced in. So the next move higher could be led to by central bankers and if they take a slightly more hawkish pivot, right, from what the normalization is expected for interest rates. But I don't see them doing that at this moment, right? One of the key benefits, even though we know that Jerome Powell is coming up very hawkish, and Fed members are hawkish at this moment, and we're saying that no, they're going far above the normalization expected in markets, and that's why we're seeing a lot of equity sell-off. And the question is, at what point would the central bankers step in if they see equity sell-off and equity panic occurring, right? Will they step in? Will they, bring in measures and look to sort of, pivot away from an aggressive stance of rate hiking is the key question there. But why would they if other factors are showing that it's quite positive? So, for example, unemployment rate. Unemployment is super low in the US, right? Unemployment rate has, there's been no adjustments to the unemployment rate. GDP came in negative, for the first quarter of this year. We'll have more results on the GDP in the upcoming sort of, weeks. Especially this week, I believe, as well as we do have meeting minutes to be released from the last Federal Reserve meeting, but we don't expect any significant changes there. So just be mindful of the minutes, any GDP results, and any other sort of CPI inflation-related reports that we see in the upcoming week. Yeah. Okay. So those will be sort of the key markets to sort of keep an eye out for. What I might do now is also bring in, let's have a quick look at if there's anything that I want to sort of mention. Yeah, so okay, so something else that I wanted to sort of also discuss. I read a report. I read a report over the weekend, and there was a report released by Goldman Sachs. Okay, it's a report released by Goldman Sachs, and what they are suggesting, if I just transition over, they are suggesting we are entering a new cycle. Okay, we're seeing a new cycle. We're not in a recession yet, right? Even though we're testing these recessionary sort of levels or bear market levels, we're not in a recession yet. Okay. Now to quantify that, it generally comes down to 2 negative quarters of GDP, right? And that sort of defines we are in a recession. But Goldman Sachs don't believe we're going to be in a recession anytime soon. There may be in 12, 18, 24 months from now, potentially, but not quite yet, right? We're probably sort of, in the late expansion and early contraction stage, potentially, right? And that's what we're seeing, sort of a slow move towards value and towards safe assets at this current moment. But from this report, they are suggesting that we're in a new type of cycle that we've not seen before. The last time this was potentially seen and where we had a period of high inflation was probably in the 1940s as well as the 1970s. So you have to refer back down to sort of, how market conditions were in those sort of, in those decades. Now, what type of cycle are they suggesting? So it may not necessarily mean that investment opportunities will be, limited, or there's going to be no investment opportunities. That's what they're suggesting at this moment. Certainly, there is going to be investment opportunities in these types of market conditions, but it's going to be much more difficult in this new environment. And it's not going to be an environment where we saw that if you just quickly return to having a significant equity exposure, right? And that's how you're going to make money, right? Every time you just buy the dip, markets are going to continue to make new highs, and that's the environment that we've seen previously, right? It's not going to be like that going forward now. That's something that they've mentioned in their report, right? There was another report by an analyst, an investment outlook report by an analyst at Morgan Stanley, also mentioning a very similar situation, right? That they're suggesting that investors should cut their risk and look at ways of hedging themselves better, or becoming more focused on stable assets or more of a defensive play, and also increasing their commodity portion of their portfolio as well. So that's something to sort of highlight there, is that, those days are gone where you have a portfolio and it's 60% equities, 40% bonds. No, bonds have been underperforming for some time. Maybe we've reached the bottom of in regards to sort of the bond dynamic. But hey, I'd say you need to be a little bit more sophisticated in your approach when you're investing in the markets. So have a portion in gold, have a portion in other commodities, and as well as look at sort of how you go about your equity play, right? You might want to sort of focus on not just growth anymore. You might want to look at value and go into a little bit more of the consumer staples potentially, as your defensive play is buffed up a little bit against your growth stocks as well. Good defensive plays could be, for example, tech stocks, not tech stocks specifically, but well-regarded tech stocks. It could be like, for example, IBM, Hewlett Packard, right? HP. They have low valuations, reasonable dividend payouts, and that's almost a defensive but growth play if you get that sort of understanding of those companies, right? Now, when it comes to sort of global macroeconomics, now this is where it's so important that we're going to be in a period where we're expecting a continuation of volatility. Yep. So we're going to have high volatility period. We know that we've got a lot of inflation. And inflation is here to stay, as reports have suggested so far. And we could even see in the UK double-digit inflation, right? So when you're looking to sort of trade, you really got to understand the macroeconomic environment you're in, right? And that's why look through the economic calendar. One thing that you should be doing as a trader, on a daily basis, a weekly basis, going through the economic calendar for the week ahead. Okay, so really understanding, what's to be expected. As I mentioned, we had Bank of England Governor Bailey will be speaking. Now, if he, goes more dovish, right, then we could see that being impacted in sterling, for example, and the FTSE 100. So noting sort of, key the tone and what's mentioned, okay, the tone and what's mentioned. So I know that there's going to be a lot of speeches in the upcoming week. We've got Davos taking place at this current moment as well, where, you've got, it's an economic forum, right? So we're going to have a lot of insight from many market participants at Davos. Going on to Tuesday, looking at German flash manufacturing PMI. So a lot of PMI manufacturing and services sort of, data being released throughout the trading day on Tuesday. Again, some speeches taking place. We've got Fed Chair Powell to speak tomorrow, as well as MPC member and ECB member as well. Going on to Wednesday, first thing, sort of, overnight in the morning, we've got the Rbnz rate statement. We have the Rbnz rate statement. Do note that, over in Australia, we've got a new PM, a new Prime Minister. An unexpected new Prime Minister. Labour, as of one, he's expected to have the majority. So yes, again, I don't see him having an impact on the Aussie too much, right? So yeah, moving on. So we have the Rbnz sort of press conference, rate statement, monetary policy statement, and the cash rate. Going on to sort of the Wednesday evening, UK time, 7 p.m. We've got the FOMC meeting minutes. So that's one thing that you need to sort of stay in the loop of. Okay, going on to Thursday, we've got the GDP figure. Okay, so prelim GDP quarter of quarter. So just be mindful of this as well. This is sort of going to hint, recessionary themes again. Okay, recessionary themes again. We also got in Canada retail sales. So just be mindful of that. And then we sort of close the week with Fed's favorite indicator, the core PCE price index as well, month over month. We've got some speeches as well, and the University of Michigan Consumer Sentiment Report. So yeah, just keeping in the loop of what's taking place in regards to macroeconomic environments and events. Switching over to the crypto space. Okay, so let's have a look at the crypto space. What I'll do is just bring this over to this side here. Okay. So what are markets doing at this current moment? So we had this, formation, symmetrical triangle formation, where the breakout, then a potential retest, but we didn't have any follow through really. We didn't have enough follow through, didn't have no bridge through the prior lows. So we can almost see that this is, no longer intact, and therefore, you remove that, and then you can see this as more of a sideways action. Okay, capitulation, as I mentioned. Markets are moving sideways. Now, let me come over to what I want to do is go to cryptocurrencies. Okay, so let's go back maybe to the daily time frame. Right, so where at one point the total crypto market space had almost tested a 3 trillion mark. Okay, so tested the 3 trillion mark. We're now less than less than 1.5 trillion, right? We're at 1.29 trillion in regards to the total market cap in the crypto space, right? So, and just looking at the last 2 weeks, right? If you just look at the last 2 weeks, where we were, so around the, around this region over here, down to where we are now, we've seen an almost $300 billion just wiped out in the last few weeks, right? And that's down from around 1.8 to 1.7 trillion. So yeah, down to sort of nearly 1.3 trillion. So the markets are down substantially from those all-time highs, almost 3 trillion, right? We're down from nearly 1.7 trillion dollars in the past. What can you say? 7 months, shall we say? I'd like to include November. November was the high in the crypto market from last year. So yeah, that's so much. So in the last 2 weeks, we saw Terra Luna fall substantially. We saw the UST collapse, unpeg itself after a flurry of sell orders coming into the market, and we just saw pretty much $41 billion wiped out in moments. Yeah. Now, let me bring that up. If I have it here somewhere, I had it. Maybe it's under a different. There we are. Just to put things in perspective, that's what it looks like now, right? So this is, Luna after, post, not a nice picture at all. Not a nice picture at all, right? So someone did a comparison, actually. Someone did a comparison to this being equivalent to the Lehman Brothers collapse in 2008. And is that a good comparison for this? I don't believe it is, but is that a good comparison to sort of, what we saw in the crypto space, that a stable coin such as UST just completely being wiped out? Is that equivalent to what we saw with Lehman Brothers in 2008? So let me give you some perspective there. So Lehman Brothers was worth $60 billion when it collapsed in 2008. Yeah. And we've seen now $41 billion wiped out with Terra Luna, right? There could be some important distinctions between those events, but it still remains a significant drop because you know, it is likely to only have a ripple effect in that particular industry only, right? So it's only going to have a large impact in the crypto space, and it doesn't have any fallout in the other markets, whereas Lehman Brothers did at that time. Okay, so one of the key differences between the Lehman Brothers and sort of the Terra sort of USD sort of collapse is that crypto markets are more contained. It's more contained. There was another report by Goldman Sachs indicated that equity price fluctuations are the main driver of changes in household net worth, while cryptocurrencies are only a marginal contributor. Okay, but while we saw the crypto tumble, it is unlikely to give consumers direct cause for concern. Right, it could hint at the changing landscape of investing, right? But with the economy set to fall further, potentially, with the sort of the cry of a recession, independent currencies could come under further pressure and have more further to fall potentially as markets look set to slow and potentially even lean more on fiscal policy as well. Yeah. So even though we've seen crypto assets lose a substantial amount of value in this period of time, that's a sizable chunk that we've seen of capital just leaving these markets, leaving this asset class. But that does not necessarily discount opportunities for growth as well. So just be mindful of that, right? We're seeing not just markets such as Luna and Bitcoin and Ethereum, so all these markets come off and sold off, but you're also seeing that being impacted in other markets such as Robinhood, Coinbase. Those are some of the companies that you should be mindful of when you're looking at the crypto space and how they're correlated as well. Just coming back to Coinbase, let's see if I've got coin here somewhere. Maybe I'll just search for coin. Looking at Coinbase. Yeah, so from where we were, from its initial IPO and where it IPO'd around the sort of the $360 mark, and look at where we are at this current moment, right? So a substantial sell-off, right? If we just look at, I'll go from the open price when it's launched to where we are now. We're down 82%. At one point, we sort of tested an 89% sell-off, right? So yes, and the reason why we saw a bit more of a sell-off and that large sharpish sort of move down lower was due to Coinbase first quarter earnings was quite disappointing. Okay, so that's sort of something to be mindful of. Their figures reflected a crypto landscape that is changing drastically and suggested that volatility is unlikely to subside over the short term as well. So yeah, just be mindful when you're trading the crypto space, the correlation that it has with companies such as Coinbase and Robinhood and MicroStrategy. They're all having a direct impact in what's taking place in this market. Now, let's switch back over to I want to go into this BTC USD actually. Just looking at the bigger picture view of BTC USD, and what you have is ETH as well. So you've got ETH and Bitcoin. Are we bottoming out? Is sort of the key point there. It seems that markets are in consolidation at this point of a hair. For there to be a confirmed, a bottom, right? You need a breakout of the high, right? And the breakout of the high for ETH will be 2,176. For BTC USD will be sort of that resistance level there on the daily time frame around the 31,500 figure, right? 31,500 figure, right? Even though we're seeing a bit more of a bullish incentive, right? You need to also know about correlation, and the correlation that's most relevant in this market is it's due to the high risk events that occur in the markets and risk on and risk off situations. Okay, so when you see tech stocks slide, you're going to see it have a correlation with crypto assets, being that is one of the most riskiest assets to be involved in, right? It is a beta for high risk assets. So if we're seeing high risk assets also move lower, you're going to see crypto assets move lower as well. So that's the direct correlation that we're seeing at this current moment in the crypto space. Yeah, so wait for sort of key levels to be breached from a technical perspective, before we outline that we have reached the bottom. But it seems that markets are capitulating at this moment. Markets are in a range. We're just waiting for confirmation from price action, realistically. And what would also be worthwhile seeing is if equity markets also bottom out as well, as they sort of reach those 20%, 30% sell-offs as mentioned in the S&P 500 and the Nasdaq. Are we seeing a bit more bullish tone? We're certainly seeing sort of, consolidation at this current moment anyway. Okay, fantastic. So that's sort of a wrap of all the key points to discuss for the markets from what's happened so far, from the previous weeks, also what to expect for the week ahead. As I mentioned, we're in a new landscape when it comes to trading markets and investing currently. Don't just automatically assume, let's buy the dip, right? We may, based on Goldman Sachs reports, we may see an environment where there could be a continuation of markets moving sideways and then a last bull run, and all of a sudden you see a large sell-off occurring in the markets. So just be mindful that we're in a very high volatile period in regards to trading. Well, thank you for joining in this session. Hopefully you've got some great insights. And if you have any questions for me, you can reach out to me directly. You know where to sort of reach out to me, and I'll speak to you guys soon. Take care. Bye-bye.